We talk a lot about the EV transition, but another part of the auto industry gaining traction, autonomous vehicles. Toronto-based startup Untether AI is part of a push to put self-driving cars on the road. It produces a technology for use in vehicle vision systems and recently partnered with GM to accelerate development. Arun Iyengar is CEO of Untether and joins us here in studio. Thanks very much for being with us.
Thanks for having me.
I guess I'll start just generally speaking, what is it you're doing? Because everybody hears about AI, they hear about self-driving cars, but what is your very specific focus area?
Yeah, Untether AI is a Toronto-based company, and we focus on what's known as artificial intelligence inference, which means as you go out into the marketplace and drive your car, then it looks at the various, like a pedestrian or a stop sign, and then be able to respond in a very fast manner, right? That's what's important to really drive the fully autonomous vehicle of the future.
Seems like a more profound problem to be solving than just, can a chatbot get back to me as quickly as we want, just because of the safety factor. What goes into making sure that that technology works?
Yeah, so the way the perception systems is what it's called. The perception system, if you think about from a human body, the sensors, which are the cameras, the radar, they're like our eyes and ears, and the perception system is a brain. So the brain actually does all the processing to understand what's going on and then respond in a very quick manner so that while, just like a human being driving a car, you got to be able to respond with a split-second response time.
And what are you finding as the technology gets more powerful in its ability to do just that?
Yeah, there's an insatiable need to improve the compute density for artificial intelligence. And where the technology stands today, I think we're still a ways from really taking it to fully autonomous everywhere. There's still a lot more innovation that needs to happen, not just from a chip level, because the chips that we have are very, very powerful, but also taking it into the policy level and the rest of it that needs to come into play on the safety level. But there's also another component, which is the energy level. And the energy level is really when you're deploying AI in a broad scale, the energy use model now goes up and goes up drastically, especially with the traditional types of chips that are being used.
And we should note, you come from a long career in the chip industry, which probably comes in handy these days.
That's right. That's right. I mean, the artificial intelligence is the one place where having a knowledge of both the chips and the hard software is a key component of what's needed to be successful.
So you have some backing from General Motors. When the automakers themselves are trying to figure out how far away we are from self-driving cars being on the roads, what are those conversations like when they team up with a company like yours? What are their expectations?
Their expectations are really to say, we have this class of problems. For example, if you're using LiDAR today, which is a technology that's for using laser for detecting objects on the road, then it works really well, but it doesn't work well when it comes to snow or rain, right? And so you end up with some radar types of applications where you can use, or you can also do cameras. So you end up with a multi-sensor model. Just like we have eyes, ears, and smell, the ability to smell, you end up having these multimodal approaches to bring in data. And they're all for different reasons. And now combining them together to make a decision. That's really the conversation that we end up having with the automakers, because that's a complexity that has to be resolved.
And you have Canadian investors as well. I think during this AI boom, a lot of people have wondered about where Canada fits in to the story. We've got great talent here. Yep. We've started a lot of great projects here, but now we're competing with the rest of the world for everything. Do you feel like the environment here is set up for Canada to be a successful player in this new economy?
Canada's got amazing software talent. Universities like the University of Toronto, University of Waterloo, and a variety of other universities really have great programs, and we hire from there extensively. And what we're doing is kind of different because there are a lot of software AI startups in Canada, in Toronto, but there's very few hardware AI startups, very few. And that's usually because people think that a lot of silicon requirements, which is what chips need, the talent is outside of Canada. And what we've chosen to say is that's not necessarily the case. We hire both hardware and software engineers right here, and we find that the people that we get are really talented enough. We're greatly talented that we can hold our own against pretty much any corner of the world. And so I think that there is a lot we could do with respect to making sure that these small companies have the ability to support externally, which is globally, but also internally, which is within Canada.
As you continue to roll out your technology, where do you see your business over the next 5 years?
Well, hopefully growing a lot, getting a lot of customers. So we're engaged with a variety of different automakers. You can name a lot of the top automakers, and we've got conversations and engagements going on with them. And a lot of that comes because of the extremely high compute density that our technology offers. Compute density meaning for any given amount of power, we have the highest throughput, which is what you need when you have a power-driven solution like a car.
And so you highlighted both the technology advancing, but still working through it all, and then policy, which is a more complicated subject.
Right.
But if you had to guess how far out we are from, on a regular basis, seeing self-driving vehicles on the road, is that something that will be a reality, do you think, in the next decade?
The self-driving vehicle prognostication is always a decade away. And it's been for the past decade or so. So I guess I could go out and say, yes, I think you'll see a lot more self-driving in the next decade than in the past decade. But to say that it's going to be fully autonomous, I think might be overcalling it for now.
Okay. Well, helpful context. Good luck in your continued career path. Arun, thanks very much. Arun Iyengar, CEO of Untether AI.
Well, BC's biggest business association is urging for a fair but fast resolution between West Coast port workers and their employers. The workers voted overwhelmingly in favor of striking later this month if a new contract can't be reached. The Greater Vancouver Board of Trade says it is sounding the alarm over the potential disruption a work stoppage at BC ports could have. For more, let's bring in the president and CEO of the Greater Vancouver Board of Trade, Bridget Anderson. Bridget, thanks so much for joining us today.
Nice to be here, Jacqueline.
So I mentioned you're sounding the alarm on this. You're getting out ahead of this possible work stoppage. Why did you feel the need to get your members' voices heard in advance?
Well, Canada's reputation as a stable supply chain is imperative to its position in the global economy. When we look at where we're at, it's a pretty fragile recovery time for the ports, given what happened with the slowdowns and disruptions over COVID, as well as the devastating floods that happened in the fall of 2021. The West Coast ports handle about $500 million worth of goods every day. That's $350 billion a year. And so that impacts businesses both importing and exporting. So this, any kind of slowdown could have significant disruptions to our economy.
Yeah, so when you're thinking about the ripple effects of that, Bridget, what sort of industries would feel that the most?
Well, I think you can probably name most of them. We have that are being imported and exported through the ports of Vancouver and Prince Rupert. We're talking about agriculture. We're talking about energy, automotive, manufacturing, and goods that we see on the shelves every day in all of our stores. So the impact could be quite far-reaching. And that is why we're so concerned about any kind of impact due to labor disruption, which could be days, weeks, months even to be resolved.
And the potential too, Bridget, that could get passed on to consumers, or perhaps, they wouldn't be able to access products that they needed.
Exactly. It could cause problems when it comes to inflation and rising costs, which businesses and individuals are really struggling with already. It also comes at a time where we're seeing a slowdown in the economy. And so there's already some uncertainty and some nervousness about what's happening in the economy. And then added to that, there are also labor disruptions south of the border in some of our U.S. West Coast ports. And so really there is a significant concern about any kind of slowdown and any kind of that traffic being diverted to East Coast ports or elsewhere. that then it takes a very long time to recover from that.
Yeah, I was just going to ask, Bridget, can any of that, those shippers reroute to other ports if they, were concerned about the possibility even of the work stoppage, so making those plans in advance, or if they needed to, if the work stoppage did go ahead?
Well, we have been seeing that in the United States and some of those cargo ships being rerouted to the U.S. And when that happens, that adds shipping time, which of course adds cost, both for importers and for exporters. And, we're not just talking about businesses, and of course they are incredibly important to this, but we're talking about consumers as well, which are already pretty tapped out, and affordability being a very big concern for a lot of families and communities. So the trickle-down effect of this is really quite significant.
When it comes to your members, are they doing anything to prepare for this possibility? Is there anything that can be done to prepare in advance, just in case this work stoppage happens?
I think we're probably all sitting on pins and needles and really hoping that the two sides can come together and find a solution before it gets to a more serious situation. We are held a little bit hostage by what happens with the ports about importing and exporting. And so we really are relying on the two sides to come together and to work to find a solution so that we don't have any work stoppages.
Bridget, really great to get your perspective today. Thanks so much for joining us.
Thank you.
That was Bridget Anderson, President and CEO of the Greater Vancouver Board of Trade.
AI hype has been in the headlines since ChatGPT launched last year. As investor appetite for exposure to this technology grows, so do the companies that want to get involved. According to this graph, the number of companies citing AI in their quarterly earnings calls has spiked this year. For more on what makes a company the real deal when it comes to artificial intelligence, let's bring in Jim Anderson. He's CEO of AI software company Beacon and social media sector lead at Glasswing Ventures. Jim, it's nice to see you. And obviously everybody's heard the hype recently, but what truly makes an AI story a successful one for a company?
Well, John, I think right now it's that classic axiom, right? If you want to get rich in a gold rush, be the one who sells the picks and shovels. So what do we see? We see NVIDIA, we see Microsoft, we see Oracle, who hit an all-time high, and they provide real foundational either hardware, chips, software that really powers this. And then you've got this next generation of companies coming along, just like you said, that's all talking about AI. Highly questionable how differentiated it will be. I don't doubt anybody's push into AI. If you have technology, you're pushing that direction. The question is it going to create a sustainable advantage for you?
Yeah, and by comparison, have there been any stories you've heard that seemed like a little more sizzle than steak?
Well, Accenture just put out a good announcement. I don't want to criticize them because they're a giant consulting firm, and I'm sure they are going to push very hard into AI. But they announced a $3 billion investment. They're going to hire tens of thousands of people. They're going to coordinate their business across multiple sectors, have centers of excellence around AI. That's great for them strategically. But in terms of, would that cause me to now go buy Accenture stock as a result? That part's maybe a little bit more questionable.
So if you're trying to assess the sustainability of an AI story put out by a company that maybe isn't necessarily, carrying an obvious picks and shovels opportunity as you speak of, what should you look for? What should you listen for?
Yeah, I would look for that. Try to find a nugget of differentiation. Okay, great. You're interested in AI. You're going to develop AI. You're going to capitalize on AI. You're going to improve your customer service. I was talking with a chief security officer of a financial services company yesterday, and he said they were using AI to play that whack-a-mole game with the attackers. They used AI to create 230,000 rules in about an hour to thwart, a cyber attack. Right. So that kind of thing. It's like, okay, that's interesting. That's a real use case. That's not just saying I think AI is interesting. It's finding a way to use AI as part of your business to help you do something that wasn't possible by humans. Like you can't create 230,000 rules in an hour using human beings, or to do something that just dramatically improves your operating leverage, your efficiency, reduces your costs, something like that.
Yeah, we made that reference to the number of references companies themselves have made to AI on their quarterly conference calls. And I think when you see a chart that shows up and away, we have talked a lot about stock prices doing the same thing this year. Do you worry about there being an AI bubble here forming that could pop?
Yeah, I think that is a concern, right? And we've seen this. I mean, in every gold rush, right? Eventually, there's a pop. I think that's sort of an axiom also of the excitement gets to be so superheated. Really, you need a correction to sort of take that to take a little bit of the air out of the balloon. So I think that's distinctly possible. That doesn't mean that AI is not transformative, powerful. Again, I think of it in many ways very similar to the internet, right? Was there a .com bubble? Of course there was, and it was a very painful pop for many companies. But then fast forward 25 years later and look at the enormous wealth creation, the enormous companies that have been created on that. So yeah, we're going to have some bumps in the road here. When timing those bumps and understanding when it's going to happen, that's truly the art of it, right?
Yeah, exactly. Speaking of pop, let's talk about the music industry and Sir Paul McCartney, making some headlines recently about getting back with John thanks to AI. What can you tell us about this one?
Yeah, it's kind of amazing, both the capability, the fact that they could take an old recording of John Lennon and sort of remix it into a song, a sort of half-finished song, using John Lennon, who's obviously long since passed away, and using his voice. And so that's remarkable just from a pure technology standpoint. You stop and think about that generative AI. I take a soundtrack of him singing and I recreate an unrelated but still his voice, recording. But then the thing that I thought was remarkably interesting was Sir Paul McCartney's attitude towards that. He's like, yeah, of course we're going to do that, right? You've got a lot of artists really concerned about the intellectual property, their copyright. It's my song, it's my voice, it's my rights. And I think they have a legitimate right to be very concerned about that. But he's leaning into it and saying, hey, we want to use this for good. We see a positive benefit because obviously you can't get John Lennon's voice again. And then more broadly, that has an issue for what happens when all of the Beatles are gone 5, 10, 20, 30, 40 years from now. Are they still going to live on? Are we still going to be hearing new Beatles songs 30 years from now because whoever owns the rights is using generative AI to create Beatles songs? I don't know that we know the answer to that.
Well, briefly before we let you go, I mean, to your earlier point, there was this song created based on The Weeknd and Drake, I believe, which those artists were very quickly, or at least their representatives were quick to shut down. So I guess the question becomes, should you embrace this, or are you risking dollars down the road by just embracing new technology?
Well, at the risk of sort of splitting the difference, you both, right? You should embrace it and understand what's possible. But I think ultimately our copyright laws, what's fair use, what's fair repurposing. There's no way in the world copyright laws that were founded in, say, the 1700s or so are going to begin to keep up with this. We're going to need a major revamp of intellectual property and understanding of how to treat that in the world of AI.
Okay, our music pop critic and AI and social media expert, Jim Anderson. Nice to see you. Thanks as always.
Shares in Gibson Energy under a little bit of pressure today. The company has struck a deal to buy a Texas crude oil export terminal for more than $1 billion, about 1.5 billion Canadian. Let's get more on the significance of this acquisition. We're joined by Steve Spaulding. He's CEO of Gibson Energy. Steve, thanks for giving us the time.
Well, thank you for giving us the time. I'm excited to talk to you today.
Yeah, so tell us, what are you buying here? This South Texas Gateway Terminal. It's one of the biggest of its kind in America.
Yes, it has a crude oil export capacity of 1 million barrels a day.
Whoa.
And it predominantly exports WTI and WTL out of the Permian Basin. And it's connected to the Permian Basin via 3 different pipelines. But it's one of the premier export terminals in the Texas Gulf Coast, and it has the ability to load. It's one of only 2 export terminals on the Texas Gulf Coast that can load VLCCs, or very large crude oil carriers, 2 million barrel carriers. Wow. So we've been looking for. Go ahead.
Oh, no, sorry. That is, the scale of this thing is amazing. Sorry, go on. What were you looking for?
So we've been looking for a strategic asset to acquire over the numerous years because we have a pristine balance sheet, one of the best balance sheets in the midstream sector. When you look at our debt to EBITDA and our payout ratios. And so we've been looking for another asset or another kind of step out for us to add to our already world-class terminals at both Edmonton and Hardisty. And so when we looked through all these assets over the numerous years, none of them really fit. But when we looked at this asset, it fit on quality of cash flow. It fit on quality of customers. It fit on, strategic advantage. It fit on sustainable business flow. So we are so excited about this opportunity and adding it to our portfolio.
We know you best because you have gigantic tanks in the Edmonton area for storing crude. So is there synergy here between that business?
Probably the biggest synergy that we've found is the customers. All the customers at that facility are the same customers that we have at our Hardisty terminal.
Right. So you've dealt with them in the past. Yeah. I want to ask you about debt. S&P affirming your BBB- rating. Of course, and it's stable, but that is only one notch into investment grade. And I think some of your notes out there, subordinated notes, are BB. That's down in high yield territory. So are you getting any pushback from investors on your debt levels?
Not at all, not at all. We actually went to both S&P. We went to S&P and had them reaffirm our credit rating before we went forward with this transaction. We kind of do that on an unofficial basis, and actually they believe we're stronger with this acquisition because it gives us a diversity of income and increases our overall business size.
This is amazing.
And we still have three. Go ahead.
I'm sorry, Steve, I keep cutting you off. I have so much stuff I want to ask you. Does this kind of make you a global player now? Do you feel like, whoa, I'm a bit of a world-spanning player here?
I don't know about global, but you're definitely North America. It makes us one of the larger liquid infrastructure businesses in North America, or our goal to continue to grow in that area.
Well, I think we have a map. You're kind of a neighbor to Enbridge down there, aren't you? You have, so we're showing your asset footprint now. So you're adding South Texas, and then you're huge in Edmonton, Hardisty. You can move a lot of oil around the country, can't you? And you can store a lot too.
Yeah, so you look at Hardisty, we move about 1.3 million barrels a day through our Hardisty terminal, which is about a little more than 1 in 4 barrels produced in Canada move through our Hardisty asset.
Wow.
And then with this asset, they move around 670,000 barrels a day of crude oil exports through this terminal. And you think back about 4 years ago, the U.S. wasn't moving any barrels via export, or very few barrels via export. So this terminal is excellent for our portfolio. We're really excited about the potential growth around it and the stable income that's going to generate. So this is probably one of the most exciting things we've done in the 5 years that I've been at Gibson.
I started to ask, Enbridge is your neighbor there. You have a big oil export terminal pretty close to you there in Texas now, don't they?
They do. So we have 1 million barrels a day of capacity exports, and they have 1.5 million barrels a day of export capacity. They have an excellent facility too. So the two Canadian companies own 2.5 million barrels a day of export capacity. And these two terminals are the premier export terminals in Texas.
Steve, before we go, just give us a quick view. Once Trans Mountain comes online, is that going to transform things, a big change for the Alberta oil industry in terms of extra egress for its product?
Well, we've already seen, differentials tightening up to $12, $11.50 to $12. So we believe, when TMX does come online, those WCS to WTI diff will continue to tighten. It's hard to say how many barrels will actually flow down TMX because the U.S. markets will definitely try to compete and hold those barrels going to there. So it's going to be quite a competition that I think the Canadian producers will benefit from.
Great talking to you today. Thanks very much, Steve.
The airline industry took on significant debt throughout the pandemic, and it was expected to take several years of operations to get out of the red. Our next guest says there are improving profitability and cash flows thanks to surging appetite for travel post-pandemic. But for the flying public, there could be some headwinds over the summer. Let's bring in David Peytu. He's the Vice President of U.S. Structured Credit at DBRS Morningstar. David, thank you so much for joining us. One of the stats that we know is for the global airline sector, while there has been a big boom, we're not quite there yet in recapturing the total demand that we saw in 2019. How do you see that playing out?
Yes, hi. Well, when it comes to travel, what we are seeing is that international travel is still lagging as China and Asia Pacific recovery has been slower than local recovery globally. And that is a catalyst that has been driving the increased demand lately. The other thing that is important to note is that we are seeing significant increase in business travel. If you look at our statistics and just look at Global Business Travel Association statistics, we expect business travel to be at about 80% of 2019 level, but that is up 24% compared to the last year. So those two trends, I would say, are driving the demand and the recovery for the global aviation sector.
Business travel is going to be just 8% of 2019 levels?
I may have misspoken. It should be 80%.
Okay, I was going to say,
Yes,
that sounds like a huge
that.
problem. Do you
Yes.
ever see, because for so many airlines, that is core, right? It's a stable part of the business. It's the people that tend to pay higher ticket prices. How do you see that evolving? Is it going to take years to recover?
We don't believe so. As I mentioned, even in 2022, that was a relatively challenging year. It was already recovered to 65%, and right now we are expecting it to be at 80% in 2023. We believe by 2024 you are going to see almost full recovery. It's just there are different business travels that we always need to consider. Conferences is one of them that we are seeing a large increase because with relaxation of COVID-related travel restrictions, people still need to travel, still need to network. So in our view, beyond 2024, we could expect business as usual.
This is a sector in which players sort of love to go bankrupt, right? It was an easy way to lose money over the long term. Recently, though, the pandemic notwithstanding, there did seem to be new religion around cost discipline. And I think about Delta kind of reinstating its dividend after having to slash it, though starting small. What do you make of, or how would you characterize the financial stability of these airlines as they deal with the issues coming out of the pandemic?
In general, when you look at aviation industry and airlines in specific, what we are seeing is that most of them are coming out significantly weaker when it comes to credit. Just they had to borrow money, they had to leverage their balance sheet, and also encumber most of their assets in order to raise cash and meet liquidity demands during pandemic. So they are coming out with, call it cash strapped, and switching a little bit more from buying aircraft with heavy capital expenses to leasing aircraft to address their fleet needs. But from that perspective, clearly they have challenges. And and some of the other operational challenges is that they need to hire more people to meet the demand and get more aircraft to meet demand, and aircraft is not available. But having said that, if you just look at business overall right now, demand is there, and that will drive their ability to improve on cash flows and generate cash flows and deleverage, which many of the airlines, especially in North America, they have started to do that.
One of the other things that we have been tracking and we've heard in the news is about all this strike action. People who have seen the huge recovery, who are also dealing with inflation, so now they want their fair share. How much of that is going to impede the ability of these airlines to have and show some cost discipline at a time where, to your point, they need staff?
Yeah, it is an interesting point. I would say that it's somewhat regional driven. If you look at U.S. and North American airlines, what we are seeing is that they've been very aggressive in addressing their labor relationships, and some of the big names, Delta, United, etc., they've just completed some of the contract renegotiations with pilots. Having said that, we did see last year contract negotiation to lead to a major airline bankruptcy in Europe. So in our view, labor relationships is a little more tense in Europe compared to North America. And it is definitely going to potentially lead to higher costs for airlines. And I think the question remains to be seen, how much of this cost increase would airlines be able to pass down to customers?
David, thanks so much for joining us with that perspective. That's David Petu joining us.